What's up, guys? I'm Jay,
I'm Christy.
and this is the Trading Floor Podcast, Season 2, Episode 10, and we are nearing the final conclusion. There's going to be another episode soon, a very, very special episode that's coming out soon. But let's not get the carriage before the horse, like some people might say. So, in this episode,
Let's tell them what it is. The next episode is going to be our 1 year anniversary episode, which is exciting. So anyway, I'm excited for
TTF,
that one.
not us.
You too.
Like,
No, not
holy,
us. No.
God, that was a
Our
close one.
us. Oh, Jay wishes.
That was a
No, no,
close one.
no.
So, in
No.
this episode, what we're going to be doing is this has been highly requested by a lot of people is building a trading plan and strategy. So we're gonna jump right into it. I'm gonna try and speed run through this. That way we could show actual examples afterwards of hypothetical strategies. So we're gonna say that again. Like these aren't things that we made. It's just like in a hypothetical situation, like what would potentially we do. So
Yeah, so I want to just quickly say before we get into this that this was highly requested by the community. We polled all of you guys recently asking about some of your experiences in the community. What would you like to see more of? And this was one of the top requested things. And we have heard you. It has not gone in deaf ears. We are definitely going to be working on more content for this too. But to get you guys something started before we disappear for season 2, we wanted to make sure that we gave this to you guys in a little bit of a presentation style that you guys can work with a little bit. I'll also make sure that I link the actual PowerPoint for you guys in the description box below. So if you're interested in like looking at the slides or going through them after we're done this, if you're more of that type of learner, then definitely check that out. If you're in the community and you want even more of this, we hear you and we are working on a full course for this that will be coming, but making courses takes some time. So for now, this should be enough to get you guys through to get practicing and get started on some of your strategy building. But we definitely wanted to get this to you guys because this is important. And it's actually kind of surprising to me how many people don't realize how to actually do this. So we definitely want to get you guys started with like the proper way to start making a strategy or work with a strategy that you have and get into the testing. So let's get into the boring PowerPoint presentation. Woo!
it's not boring.
Yeah, I
So
feel like this should drum roll.
building a
It is boring.
strategy trading plan by Christy and Jay, Trading Floor Podcast. How cute. So before you start, it's important to identify certain amount of things and certain realistic goals, I guess is a good way to put it. How much trading experience do you have? Like be realistic with yourself. Watching a couple YouTube videos, not enough. Like be like in the case of like you probably don't want to start at 1 minute scalping as a beginner because you need to have conviction. You need to know what you're doing. You need to be able to understand the markets and everything at a very fast pace. And it might frustrate you as a beginner if you're trying to 1 minute scalp. So that might not be a good idea. And kind of going into that self-analysis, like every single trader thinks and sees things differently. Do not get married to a specific style of trading that you're trying to learn. This happens so many times. It's happened with myself as well, where I thought that I was learning the holy grail and I was on the right track, but mentally and emotionally, it was just not for me. I could not handle the losses that I would see. I was trading way too much and I just needed things to slow down at a slower pace. Maybe you're at a slower pace, vice versa kind of situation. And it's not working out for you. You can hold your emotions really well together, which majority of people can't, to be honest. And you just need something a little bit quicker, then make the transition that way. Like if things aren't working in your testing and things aren't working, even if things are working in your testing and things aren't working in your live trading, make a change. If you consistently do the same things over and over again, that's the definition of insanity.
Yes, I agree with that. And I just want to say self-reflection is a big thing there. I think it's important to be honest with yourselves when you're thinking about that step of like just kind of being like, where are you really at? And like Jay said, don't overanalyze how far you actually might be because you watched a couple videos does not mean you're very far into this. So be honest with yourselves there. Don't be afraid to relearn concepts again, maybe that you might not have fully understood. There's a lot of times where we're in a rush to get to the end game here. But the reality is you try to skip through steps a little bit too fast and you're not completely absorbing what you really need to be absorbing. So I think it's important to kind of like be truthful with yourself. Like, did you just gloss through certain content that honestly is probably more important than you realize? And if you did, I highly suggest before you get into the strategy planning that you go back and relearn all those basic concepts again. Truly try and pay attention and like revisit them. If you have to rewatch a concept for it to sink in a few times, don't feel bad. Lots of us have to do that. So that is something I would say. And the other thing what Jay said is don't stay fixated on an actual style for yourself. That is huge. Just because I might trade a certain style or identify as a
The
certain style
strategies and
trader,
markets don't
or
care about
Jay
you.
might. Right. Just because of somebody you admire, though, or you like look up to as far as a mentor may trade a certain style, doesn't mean that that's fit for you. You may visualize and connect it totally different. And while it's very nice of you guys to admire certain people's style of trading, you need to be real with yourself. Again, self reflecting and saying, does what they're doing even make sense to you when you're on your own? Because if it doesn't, you're just wasting time and going to get frustrated. Figure out what style really does resonate with you. A little bit of a tip for you guys if you are looking for some help with trying to figure it out because you're just like totally clueless and you have no clue where to even like how to start. Go to babypips.com. They have an assessment, a little quiz you can take on like what style trader are you? And they'll
Yeah.
kind of gauge your personality. It's a stepping stone, but they do gauge your personality to kind of see like where would your personality and the way that you react to certain things kind of fit in to like what style trading. And sometimes that's like a good place to just even start at, I think.
That's actually the
So
first section that I have, as you can see in the next slides, the aspects of a trading strategy and plan. You have these 6 things. I'm going to go into them each individually. You have time horizon, you have market conditions, you have price action, technical analysis, aka PA and TA. You have fundamental analysis, which is FA. You have your indicators or your tools that you use, and risk management. I'll say this at the beginning, I'll say this at the end. You don't need all of these things. You need some of them for sure. Like risk management is a must, and market conditions, you need to know what you're getting yourself into. But certain things like price action, fundamentals, indicators can all be kind of interchanged. So I will say that. Time horizon, Christy kind of already just discussed this. Like, well, for the second question is to not get too far advanced, how much time do you consistently have to trade? Specific, consistent hours is what I mean. Not like, okay, I'm gonna trade an hour today, but like tomorrow I'm gonna trade like, I don't know, 2 hours, next day 30 minutes. Set specific times, that way it's easy for you to backtest. For example, I'll put 2 examples. First 2 hours of London open Monday through Friday, that's your time horizon that you could trade. Maybe on Monday you could trade the first hour London open, Wednesday 2 hours indices open, Thursday 2 hours of Tokyo open. As long as it's consistent and repeatable, that's all that matters. Make backtesting more efficient. Like, well, it makes backtesting more efficient, should I say, and it gives you establishes a routine basically. And whenever you get into a routine in the markets, you can start to understand certain volatilities and certain times. You might start seeing peaks at certain times, or price tends to maybe reverse at that time. You'll start to see potential tendencies that most people won't, because you're staring at the same thing, or 1 to 3 trade or 1 to 3 pairs, I would say, like multiple times, and like you'll start to notice things that you didn't notice before. Main thing, really huge, because I used to do this too. Do not chase the wins by consistently flipping sessions without proper testing. Like I would do this where I'll be trading mixed, and then London would pop off the last week. I'm trading London. I would trade London. I would not get any wins. Mix would pop off. Oh, I'm back to mix. And like, if you don't stay consistent, you won't find your wins. So that's huge. And so, what time frame should I try? And that's kind of what Christy going back to, is what type of trader you want to be. Do you want to be a, hey, Roxy, by the way, we have a special guest, which is Christy's dog, Roxy, in the background. So if you hear her barking, sorry.
Mute myself.
But
Okay.
what time frame should you try? What style of trading should you be? And it goes hand in hand with the first question. If you only have a couple hours, then 15-minute is probably as high as you can go. I wouldn't recommend going any lower than the 5-minute if you were beginning. And you'd be surprised, like 2 hours of trading on the 15-minute is 6 candles. It's possible to find trades within those 8 candles. It's possible to find trades within those 8 candles. It really is. And also, what I want to say is that, well, Christy brought baby pips. Find out if you're a scalper, intraday trader, swing trader, and vice versa, and go about it in that regard. But any time frame is viable. You can make money with anything. You can go on the daily. You can swing trade on the daily. You could be intraday on the 5-15 minute. You could super scalp on the 1 minute. Whatever works for you. 30-minute, 1 hour, who cares?
Yeah, time frame's important. A lot of people like hyper focus on that sometimes, I think, when picking a strategy, and they only
True.
focus on building around the time frame. But in my experience with strategy building, and Jay's, I could probably agree with this too. The time frame usually doesn't matter all that much. That's usually pretty versatile once you find consistency, and you can already be in the testing phases and then decide what time frames work best. But it is good to identify realistic goals for a time frame. If you know that you have hardly any time to sit at a chart all day, like during the days, and really sit, then obviously a 1 minute doesn't really make much sense for you if you truly can't sit. And you're probably looking at more like you would sit and look at a higher time frame, like maybe a 1 hour to a daily time frame, because you might only be able to sit at the end of your workday and then look at it. And it might not be the best market to be entering into, and you can just do more like a daily analysis. If you have time to sit at a market, then maybe a 1 or 5 minute or 15 minute is more realistic. Point is don't be hyper focused too much on the time frame only because, oh, this YouTuber trades on the 1 minute time
It's the
frame, it must
same. It's
only
the
work on
same.
that.
Don't marry yourself to certain ideologies. Like
Exactly.
you want to be a 1 minute scalper. Well, maybe you're not supposed to be a 1 minute scalper. If you
Yeah.
tested things on the 5 minute and you don't really like the win conditions, try the 15. If it's better, why not go to it? So
I'm going to call out our editor and lovely friend Jenks here. So he edits these. So Jenks, I'm going to call him
oh,
out for this, for admitting recently to Jane and myself that he was like, I don't know what I was doing on the 1 minute time frame, why I was so fixated on figuring out the 1 minute so much, because he's loving the 15-minute time frame now. And that kind of just goes as a good example. And we've all been guilty of this too,
oh yeah,
where if you're kind of like having a hard time making sense of a time frame, don't hyperfixate on this time frame and be like, but that's what I trade. If you can still make sense of your strategy on a higher time frame or in a different time frame, just a different time frame in general, and you're finding more success with it, don't be so stuck again, like Jay said, or married to this idea that I have to be this type of trader or this type of time frame. The time frames can be versatile, and most of our experience when we are strategy testing, we find that the strategy itself is the priority.
Mhm.
The idea of what needs to be met, the criteria is the priority, and then usually with our testing, the actual time frames almost always kind of work out. There might be some minor tweaks or adjustments you have to make, but that comes after your data collecting, and then you can kind of analyze what needs to be tweaked if you're really dead set on a time frame. But anyway, that's my. We're going to give you a big spiel about that just because we see that so often. The time frame.
Yeah,
What time frame should I trade? What
doesn't matter.
pair should I trade? And these are
Whatever
things that
works best for you.
honestly, yeah, these are things that will kind of they kind of almost will like come forward with themselves once you start actually building the strategy, and you'll be able to figure out what works best for you. But if you are,
That's probably the most annoying answer that I give people, and they don't want to hear whatever works
yeah,
best for you because they
yeah,
don't like. I don't feel like working. Just tell me what works. And I was like, I don't know you. I don't know how you trade. I don't know how you cope with losses, with wins, your risk. No clue about you. So how can I like develop anything when I have no
yeah.
clue? Like you have
So
to figure out yourself like what works best for yourself, and it's
So
trial and error.
just yeah, just know that when we are saying it like that to you guys, it's not that we are being dismissive. It's truly because this is kind of how we think, because we do build so much that we're like, we don't know. Honestly, so many of these things could work, and we just don't know, because you are going to have to put in that groundwork. And then once you if you submitted a journal or something for us to see, it's a little bit
That's a little
easier for us
different.
to
Yeah,
that.
that's a little
Yeah,
bit different.
then we can really analyze and give you some feedback. But to just blankly say what time frame, what session should I trade to get the highest win rate, it's like I don't know, it's a needle in a haystack when you
All
ask
right,
that
so
question. We don't know.
getting back into the
Yeah,
second topic, which is market conditions, time horizon and market conditions kind of overlap in the sense of this last idea of make sure you understand what you're trying to trade and get into, in the sense that if you can trade Tokyo session Forex pairs, you want to be focusing more on like odd, like Australian dollar, Japanese yen, New Zealand dollar. If you're trading NASDAQ indices, you want to make sure you're trading like indices open, New York. You want to make sure you stick and you can identify the trends and like the peak volatility hours, because that's when you get the movements in order. Not saying that you can't trade NAS on London, but you get more movement and more volatility during the New York session when it's actual, like when it's open in its actual session. So make sure you understand that too. So market
it's the
conditions,
volume. Just to be clear, you want to be trading when there's volume.
yeah,
Otherwise, you're going to get stuck in a slow market that's not moving and potentially higher spreads. And that just gets frustrating to sit in. So if it's not part of your plan, if it's part of your plan, that's a little bit different. Like I said, some people who work jobs have to kind of incorporate that type of like daily
Yeah.
analysis.
It all
Majority of
comes down
people
to your
don't do that.
testing at the end of the day. If
Yeah.
your testing's good, who cares when you're trading or what you're trading? If you're winning, you're winning. Don't
Right.
care about what other people say. So,
Right.
market conditions. You want to build your daily directional bias if you're intraday trading. If you're swing trading, it's more kind of like a weekly or monthly bias probably, but it's the same concept. You want to build a higher time frame bias of what the market is doing. Do you want to trade with the trend, or do you want to spot reversals in the market? That's completely up to you and what you want to find. So next thing is identifying basic trend structure. This is like trading 101. Spotting higher highs and lows for bullish structure, lower lows, lower highs for bearish structure. You can use things like moving average indicators to help simplify that process for you. I went over some quick examples. You can just slap on a 200 moving average in identifying trend. If price is above, that's potentially bullish. If price is below, that's potentially bearish. You could do things kind of like Artie has done with 3-line strike, a combination of the 21, 50, and 200. And when they all line up, that's bullish trend. And like whenever the 21 is above the 50, above the 200, that's bullish trend, vice versa for a bearish trend. You could do something kind of different, which kind of merges the moving averages into more kind of a price action kind of feel, where you have a 2 moving average combo, like in this example, like a 55 and an 89, and it kind of forms like this little cloud. And what happens is once the 55, let's say the 55 crosses under the 89, and so we're looking for potential bearish entries. Once the 55 moves into like the little area of the 55 and 89 and then pulls back out, maybe you can look for some sells. So that's just kind of a simple idea of basic trend structure there. Also, many indicators on the opposite side of things for reversals, many indicators in market theories can help you spot those. Things like the MACD, RSI, TSI, ultimate oscillator, popular divergent spotting indicators, which can help you see reversals. Also, certain theories like the Forex market cycle, which is a probability that the New York session for Forex pairs likes to reverse the trend of London. Not always the case. Like I said, it's a high probability, won't always work, but you can look into that yourself. And then the daily open indices open theory is that indices always wants to return at some point to the daily open. If indices opens at the daily open, then you can potentially see consolidation during that time for maybe an hour or a few hours. So there's just some things some theories that you could potentially spot in your strategy. So next, price action technical analysis. We'll be going over a lot of examples soon after the fact, but it's one of the most important sections outside of risk management. I think, Christy, you could probably attest to this. Just knowing where you are in the market and areas that you need to target or potentially exit at is like very key. Price action is king, like people always say.
Yeah.
And you need some way of identifying key levels to target or be aware of. If not the case, if you're not finding structure, if you're not trading price action technical analysis, you're literally trading blind. You could be entering a signal that's saying buy, and you're literally smack dab against a daily resistance that is just not going to get broken. And you're
Right.
like, why am I losing?
And that's where indicators aren't magical and there's no magical indicator. You need to put some of your own analysis into it, and it will make a world of a difference. We've talked about this plenty of times where we do back tests because we need to stay consistent and non-biased. So we like to see worst case scenario. So we do set a set of rules and we take every single trade that meets that criteria because we want to stay unbiased about it and see if worst came to worst, what would this look like? But that doesn't mean that we personally trade those strategies like that way. We don't do that. And you guys have seen like on my YouTube as well as in the community, or if you are or whatever, how we have personally all like kind of put our own spin on things. And that's where you see those win rates like go way up because we're not using just signals alone because nobody's claimed to ever have magical indicators, especially us. I know not us. So we
Wait,
don't claim to
really?
have that.
Wait,
We
that
definitely
wasn't in the fine print.
no, we definitely 100% back like proper like analysis and learning all these basics and using price action. And that will be huge as far as making sure that you guys get a little bit of a better analysis. But with that also comes you need to learn these basics and you need to really understand these concepts. So making sure you fully understand them, kind of going back to what I talked about in the beginning, make sure you fully understand them. If you don't, go back and revisit them, relearn them again before you keep trying to move forward because you're just going to keep wasting time and
Yeah.
needing like resistance every time you try to move forward with the strategy building if you don't truly understand it. Once you do, though, it's going to be like, ah, like the holy grail of like
Oh,
aha moments. Yeah, everything will just make sense and be so much easier when it comes to your strategy building.
I heard
Yes,
Roxy
that's
in the
my.
background. She agrees with you. It was a
She said
soft
yes.
it was soft agreements, but like she's like, you know what? You're not wrong. But with price action though, it's extremely hard to incorporate properly, but it's not impossible. Like you
Right.
can do this.
It takes
And
practice,
it,
but yeah.
it'll be tedious and it'll be hard to back test, but it's extremely beneficial for you in the future. I will say.
Yeah.
Um, so some implementations that help make testing and trading price action a little bit simpler as you kind of start to learn it, like I brought up in the previous market condition slide about using moving averages as confirmations, kind of like the pullback theory, where if it gets in that little bubble between the 55 and the 89, pulls back into it and then exits again. That could be a retracement that potentially just happened. Kind of maybe you could find a price pattern of some nature. Christie's simple style, y'all have seen this in like almost all of her videos with like Stairmaster and
Yeah.
Happy Trail. Literally just move up a time frame and mark the high and low near price, and then go back into your trading time frame and mark a middle zone and trade around that. It can literally be as simple as that. People think there's some holy grail, but the holy grail is sticking to your plan and proper risk management. That's the holy grail. That's everybody's trying to find all the theories and all the, but at the end of the day, you can literally make money with anything. And it's just sticking to what you've tested and proper risk management that will save you. And then I'm going to show some examples after the fact, but you can also use like the highs and lows of sessions in the case for like indices, using the full New York session high and low for indices as key levels, and they could react off of it. If they don't go there, you don't trade. So be it. And then also patterns are really good for potential executions confirmations whenever you're trading kind of specific price action only kind of vibes. Candlestick patterns that reflect your trading style. For example, if you're doing a pullback strategy, if you're using like the MAs, which hypothetically you're using the moving averages as confirmation pullbacks, you want to see an evening or a morning star depending on what direction you go with, and that could be a great combo. Um,
I'm a
simple.
huge. Oh, sorry.
Oh no,
I was gonna.
you're a huge sorry. Like why are
I'm a
you?
huge I know. I am a huge fan of patterns, and I just want to say that I mean, in the community, we have two different courses. I have a candlestick pattern that's pretty basic, but then there's also one that Sven has supplied that has a PDF. So there's two PDFs in there. If you haven't ever seen them or used them, I highly recommend that you do look at them. And they are with that candle reading course that I have, which is under the how-to videos sections now. But I highly recommend, even if you're not in our community, if you're just a YouTube watcher who just likes to hang out with us in YouTube world, that's totally okay. There's lots of free candlestick reading pattern YouTube videos. Some of them are kind of lengthy. Spend the time watching them. I promise you, taking the hour or two to watch the video and really absorb it will help you so much when it comes to actually like seeing certain things on your charts. Huge fan of candle reading, huge fan of
I'll step
chart
back though.
patterns.
I'll step back for a second. What identify the ones that you would like are seeing on the charts or like liking and test those. Don't
Yeah. Don't
don't
do
be
all of them.
grabbing, yeah, don't be grabbing all the patterns like, oh,
No.
well, this pattern's happened on the 4 hour, but this has happened on the 1 hour, but this happened on the 15. No,
No.
you set your own rules. You know where your troubles are, you know what you're good at. So if you're
Yeah.
having trouble with analysis paralysis, just be like, okay, I'm looking for evening and morning stars on the 5 minute with pullbacks.
Yeah.
I
You
don't
like
care what's happened on the 15. I don't care what's happened on the 1. Just test that. If it's successful and you're comfortable with it, then and it's profitable, then go with it. Don't worry about all 200 patterns. They're good to
no,
learn.
you don't want to combine patterns because you're going to start seeing them everywhere. So you want to just stick with them, like Jay said. If you like tweezer tops and bottoms, great. That's awesome. You like M's and W's, even that's good. That's your thing. You like pin bars, that's your thing. Like if you like little kangaroo tails, that's your thing. Like there's so many of them, and all of them mean something. And if you will see them repeatedly happen. So if you are finding them, stick with that one. Don't do all of them because you will overwhelm yourself for sure. But it's just nice to kind of understand also just what they mean. So sometimes like having that extra confluence for what that pattern means along with your analysis, and then seeing like a solid rejection pattern that might mean a reversal is coming and you were thinking that anyway. It just helps to kind of confirm sometimes. But when you're building a strategy, that is something that if you're going to use it as extra confirmation, that's great. If you're building your strategy, though, like Jay is saying, do not add in too many of them. Just stick with one. That's what you look for all the time, repeating to stay consistent with it.
Before you ask a question, before you ask a question in the group, think to yourself, like, you're like, oh, I'm wondering if this is better than this. Test both of them together. Like, if, for a random example, I wonder if a 55 moving average, it might be better than 100, which might be better than 200. Add all three of them to the chart and like incorporate it and like add a column on the right side and be like, this was with the 55 moving average. This was for the 100. This is for the 200. And then go back. You could filter the wins and losses using a 55, a 100, and a 200. If you're unsure about something, just test it out with the other thing. Like, that's how you understand. Like, don't assume, because when you assume, that leaves some discretion and the markets will probably take advantage of you.
Yeah, but the patterns are definitely something you're going to see. So
Roxy
getting
agrees
back on
with me.
track. Yes, she does. Patterns are something you guys will definitely see, and you'll see them repeating happening. So you will see them over and over again. So I feel like if you're a pattern person and you have one you like, you'll definitely learn what I mean by that. Another thing, though, this is a total side note, and I am going to sidebar here, is somebody recently kind of brought up like harmonic patterns, and I was loving
Oh,
that
yeah.
because I'm an old school trader, you guys know. So I'm old school. So harmonic patterns are like old school for me, but I learned all my patterns that way. And there is an actual algorithm to it all. And that's like what the Fibonacci retracements are based off of.
It's
And
like fibs
Jay and
and
I will,
fibs.
yeah, it really is. It's like fibs and then some cute little
It has to
animal
retrace this
patterns.
much, but then it has to extend this much, but then it has to come back into retrace. And
It's
it's like,
all,
it's insane.
yeah, all based off of mathematics and stuff and cute little
If you're a
patterns that
math
for
nerd, you love
me,
it.
yeah, if you're a math nerd, you'll love it. But also, if you like easy kind of concepts to see, like, I feel like they did a good job at like giving cute little animal names because I like easy to digest like names. So when they're like, oh, that's a shark or that's a bat pattern, like, I don't know,
Baby
those
shark.
are things. Yeah, those are things that just kind
All
of like
right.
make it easy for me to say. So,
Side note,
sidebar,
done.
sidebar is we will make some more information about harmonic patterns, but I don't want to confuse it in here. So you don't need to know that for this, but I do want you guys to know I heard that and I do love that suggestion. And I think that when a lot of you guys like see some of these patterns, you're gonna be like, whoa, those are I've already known about it, but I just never knew what they were called or what that was.
Yeah.
So anyway, all right. I digress. We can move on now.
Yeah. Thank you for digressing. So, fundamental analysis. This is usually something that's overlooked a lot of times, and that's okay. It can be very complicated if you don't know what you're looking for. But basically, in fundamental analysis, you're understanding the value of the
I'm gonna
asset.
interrupt. It is not okay that you do not know fundamentals.
I'm
He says
saying
it's
I'm
okay if
saying
you don't
like
know it. It's not
on the
okay.
higher scale, like you should know a bait. Like, this is what I'm getting into. You should fundamentals. Before I
All
was
right.
rudely interrupted, is understanding the value of the asset and why it's currently moving in its specific direction or could reverse. And so I explain this all the time. And if you want more about this, I only have one slide. I do a mini course on fundamentals on the website if you're a TTF member, so you could check that out as well. But um, very small logic is price action and technical analysis tells you areas that price could move, but it doesn't tell you when potentially it will move, and it won't tell you why price is moving that way, but fundamentals can. And so it could also vary on what time frame and style of trading. It's very dependent on that, I will say. If you're trading on the lower time frame where you're scalping intraday trading within that day, you might not see much effect unless it's like crazy high impactful news like NFP, or right now with like interest rates and Fed funds rates and things like that. It can be very impactful during the day. But if you're higher time frame and swing traders, it can really have great value for you because it can help validate you holding your swings longer and you potentially get into more entries, I will say, for that. And then, like I said, you need to have a mindfulness to news. So whether or not you're scalping or swing trading, it's important to keep up to date on news to understand its potential effect on price. Like I've said, every time we're raising interest rates, that is trying to decrease and combat inflation, and so that will strengthen forex pairs, but it might hurt the indices markets and stocks because higher interest rates hurt businesses. So like I said before, check out the mini fundamental course on our TTF website if you are a member. And for an example, kind of went over this. I'll actually go over this in the charts after we finish this. But the G7 countries, aka Canada, France, Germany, Italy, Japan, UK, US, and like the European Union is basically the G7 countries. In 2022, at the beginning, they had a meeting that they were all going to raise interest rates to combat inflation, except Japan. Japan stayed at its negative 0.1. And basically, not until late October was there some speculation that Japan might think of pivoting and like upping their interest rates. Literally knowing that information as USD is like skyrocketing and Japan is completely being the punching bag of the world, basically by borrowing money from. Like you literally all you did was buy. Like all you had to do was buy UJ in 2022 and you're winning. So just kind of a random side note. So indicators, shameless plug. Using the foundation from the previous slides that we just given you, you can apply that to the TTF indicators to create an amazing strategy. If you don't believe us, if you join the community, check out the previous 3 months that we did Strategy Wars in the testimonials chat, and you'll see hundreds upon hundreds of daily testimonies every single day. Would you like to add anything there, Christy?
No, that's just true. No, that's true. What you'll see
Facts.
though, a lot of the time is they aren't actually using the exact strategy that we're
Yeah.
giving. And it's not meant to, the strategies we give are just very basic guidelines, kind of introductions. Like I said, we test those strategies and we do keep up with the back testing, but it's all very like bare bones. Like if you took every signal and just followed those exact rules, like what would you get? But we have to keep the rules a set way, very unbiased, because everybody has a different level of analysis. And we can't use that in our back
I agree,
testing.
Roxy.
Well, I'm so sorry. Nonetheless, I am dog sitting and it's clearly not going well. But nonetheless, you guys should definitely be using your own, like taking it as inspiration and then applying your individual personalities and customizing it a little bit to what your criteria are, like what we kind of already discussed earlier in the PowerPoint slide, and then making it your own. And that's what you will see in the testimonies when you go through there. You will see a lot of that. So I will mute myself now so Jay can continue.
So continuing on that note, there are, it's not limited to, like I will say, but the major sections and aspects that you want to consider with indicators are covering trend. So like we've gone over moving averages, MACD, the Ichimoku clouds can help you identify trends and determine if the market is bullish or bearish. Also, you want to find momentum. So the RSI, Stoke and Stochastic RSI, not only give momentum, but they can also kind of give trend as well. So it's kind of dual purpose in that sense. You want to know the volatility. You can use ATR bands, Bollinger bands, or ADX indicator for a few examples. Not limited to, just throwing random examples for y'all to try out. The ATR and the Bollinger bands can double as like understanding how volatile the markets are, and could also give a suggestion for stop loss placements. They're not always perfect, but they do give a guideline. I rather, me personally, and Christy as well, we rather use structure, like recent structure, in order to place our stop losses. But these do kind of give like an aid potentially of what to use. The ADX indicator is a little bit different. It helps you determine if a market is experiencing high or low volatility. And so what you want to do is left click inside the indicator and you'll hit Alt plus H. And what that'll do is that'll enter a line inside of the indicator. And you want to put that line around 20 or 30. You can test this to see which is better. Basically, it tells you if the line is under, if the ADX line is under that horizontal line that you drew, then price is probably consolidating and there's low volatility. If it's above, price could be trending and there could be higher volatility entering the markets. So just kind of a rough guideline of that regard. You don't necessarily need this, but this is just examples of like what you could potentially use. And then last but not least is volume. Volume is like a forward leading indicator, but it shouldn't be solely used or relied on for trading, because it might not always lead you in the right path. But if you combine it with everything that you use, it could be a dynamite indicator. So the CDV, cumulative delta volume, is a really good indicator. And also volume profiles. I know Artie's done a couple videos on volume profiles. It's been getting like a lot of steam recently. It's been trending more. But as far as CDV, cumulative delta volume, very hard word to say really fast. It records the change in buying and selling volume pressure and can give some dynamic divergences. I do agree with that. It tells you if the markets are having more buying power or more selling power. This is way more prevalent to use in things like futures, indices, and stocks. It's less prevalent to use in the Forex market because Forex sees like $6 trillion daily flow in and out. And majority of that money comes from central banks. So central banks kind of control the volume. So volume indicators for Forex might not read as well as they do for stock-based systems. But it potentially could work. You could test it out in Forex and see how well it does. But I'm more prefer in the lines if you use that with like indices, stocks, or futures. So
Jay's been loving that, by the way. Like
volume
look,
profile. It's an
you've been
oldie.
loving
It's an
it.
oldie but a goodie.
Yeah.
Just like yours.
He's
It's
just
like I
like,
forget it. I forget about things, and I'm like, that's why I used to love you.
yeah.
You know?
He like has been blowing up my DMs for like the last like I feel like week or 2 weeks with this. And he's like, look how
Blowing up,
good this is. Yeah.
blowing up.
Blowing up.
Mm.
Is that not a word you could say this day?
I don't
Is
know
no?
what I don't know what you oldies say. Like it's hard keeping up with like modern day and like the Stone Age. But anyway,
All right.
volume
Anyway.
profile. Volume profile displays like trading activity over specific amount of time period at specific price levels. It's pretty cool. It tells you potentially how many orders of buyers or sellers there are at certain points, and so it can kind of give you like key levels of where you should probably look to target, exit at, and things of that nature. But yeah, that's indicators. Like you don't need all of these. Like you could use 2 trend indicators and it works perfectly for you. You might not even need like a volatility indicator. Like it just these are
You may
aspects
not
that
need
you
any
might
of
not need
them.
any of you might not need any of
You might
them,
need any of
but
them.
these are just
Well,
ideas of what you should look to cover. And then if you notice that it's like, well, like this is always in confluence with this, so it's kind of like this doesn't filter anything for me, it's not really needed. So it's just kind of
what
like
we're trying to show here, though, also when we're strategy building, a key thing I think just for you guys to keep in mind is a lot of times we'll ask you guys to say, what else could I put with something? And what you're kind of missing a lot of the times is knowing what the indicator is even doing, to be quite honest. Like, what does the indicator do? And a lot of times you'll do things like, oh, I have, maybe you have like, I have an ATR on and you think I should put Bollinger Bands on too? And the answer is no, because now you have 2 volatility indicators on and you're not solving whatever the problem might be where maybe you're failing to figure out trend. So maybe you have volatility, but you can't figure out the trend. And
Roxy
you're like,
said,
well,
amen, sister.
yeah. And you're like, maybe if I put Bollinger Bands and you just kind of start throwing all these indicators you've heard out there instead of trying to think like, what am I trying to identify as my problem that needs to be fixed? So that's the idea here where you would have one of each of these if you really needed to, or if something's missing in your strategy and you're struggling somewhere, you should look to try and identify what it is and then look, maybe just these are examples, but maybe look for an indicator that would help you with that. Or no indicators. If you're purely price
Or
action,
no
you could also do
indicators.
that too. Yeah.
Might not need them. I will say this is the most important section, and people will always disagree with me, but like if you can't nail down your risk management, there's always going to be problems. Risk management loses accounts. Like strategies don't lose accounts, risk management does. Like you could say all you want, but if you stick to proper risk management, like I've been saying, you could literally make money with anything. You could slap a 200 moving average on a 4-hour chart and just buy and sell off the crosses and make money. Test this before, but I'm almost positive with proper risk management, you could do it. It's just people don't want to wait that long on the 4-hour to wait for the 200 moving average crosses. But I digress, like Christy says. It's important. I will say that it varies depending on if you're doing a personal or funded account. Specifically, majority of the people in the community and people out there are more on the route of wanting to save up a little bit of money to do a prop firm account and then get the ball rolling there. That way they can fund that personal account, which is perfectly fine. Or maybe you don't trust prop firms and you do strictly personal. So what I'm gonna focus on here is funded accounts. And so it's important to determine before you even start with your strategy plan, it's important to determine like whatever prop firm that you're looking to do and what their parameters are. Because so many times I've seen this happen to people where they literally build up a dynamite plan in their eyes and then they go to sign up for a prop firm and be like, oh, I didn't realize the drawdown was 5% when I'm placing 5 to 10 trades at a time, all risking 1%. And that's how my strategy works. Well, it's like, you need to understand what you're getting yourself into before you build a plan. Like, how can you build a plan for something that you have no clue what you need to do? So there's 4 main parameters to focus on with prop firms. First one's profit target. Second one's daily max drawdown. Third one's the amount of leverage. Usually you can kind of get away with that, but sometimes it comes into effect, especially a lot of smaller prop firms will try and get you here. And then last but not least, the most fearful metric people have is the days given to pass. Usually that strikes fear into everybody's souls. But focusing on the first thing, profit target. You need to prove that your system and back testing can hit that monthly goal. And what's important after you do your testing to subtract a little bit of percentage off, because you're not going to trade perfect to your back testing. And if you say, "Oh no, Jay, I'm going to trade perfect," stop. You're lying to yourself. Like, stop it.
Yeah.
You need
Okay.
help. Stop. You need to get help. It's not
There
going to
needs
happen.
to be there needs to be some percentage that you account for human error, and that's the reality of it, or mistakes that potentially could happen. So if you are just barely scraping by making the percentage every month, you might want to reevaluate maybe how can you fix this a little bit, to make sure that you definitely will clear that percentage a little bit higher, because the truth is the pressure will get to you, like Jay is saying, and you will likely make mistakes that
You'll
you might
add
not have done.
things. You'll add things to your strategy you didn't test. You'll be hesitant after you've seen a few losses, even though like that's common to see because you expect to just all of a sudden win 100% of the time when your back testing says 55. It's like small things like that. But if you aren't consistently hitting the target in testing, consider 2 things. I really recommend the second. I barely recommend the first, but some minorities can account for the first thing. So first case is if you're trading on a higher time frame, you're kind of swing trading. You can hold trades for a longer amount of time. You kind of have to wait a little while. You might not get a lot of entries during that entire month. If your win rate is really good or good enough, you might look to up your risk. Instead of risking 1%, maybe you risk 2% if you only get like 5 to 10 trades potentially. Second option is you test and find another profitable pair to add into your system. That way you have more potential trades for more potential gains that you've tested for, and everything looks good. So those are kind of the 2 main things to look out for. So getting into daily and max drawdown, this is very important. Majority of prop firms are like a running equity drawdown. So what that means, even it means the daily 5%. I'm just assuming majority of people have like a 5% max trade daily drawdown. It means even if you're positive, let's say your trade is up 7% and you're about to get that 8%, and your trade goes from 7% to 2%. That is a negative 5% like daily drawdown, which is annoying, but like your equity of the account had reached 7% and it just lost 5% of the running equity, and you would lose your account that way. And people are like, that's crazy. It's their money, their rules. You read them yourselves, you didn't want to accept the rules, and you kept going anyway. So be mindful of that. Also, you need to realize the situations of how you're trading. If you have 10% max drawdown and you're risking 1%, taking 5 to 10 daily trades a day, and it's not that very high of a win rate, you got to be careful. Like you need to be mindful of how big your losing streak was in testing, add a couple losses like I say in here, and then use that as your risk percentage per trade. For example, that I use, let's say you have a backtested strategy, you've seen 7 losses in a row, round up to 10. The firm has negative 10% overall drawdown. Well, you can risk 1% per trade, because if you lose 10 in a row right off the get-go, you lose your account, which you've never lost 10 in a row before in testing, assuming that you've done more than a month of testing, hopefully, like months of testing, like as far back as you can go, hopefully at least 3 to 6 months. If you're on lower time frames, ideally like a year, but things of that nature to account for. Next is the amount of leverage. Majority of firms, like I said, you don't have to worry about that. Most are 1 to 100. But there are some firms that you need to always double check that have some lower leverage that try and screw you over. I've been there. I'm not going to name them, not going to name drop, but I've definitely been there when I realized I created a plan to trade 1 to 4 trades at one time for 1%. So anywhere between 1 to 4% running risk, I guess you can call it. And I had a max leverage of 1 to 10. And with a 1 to 10 leverage, I was able to place one trade. I couldn't even place a 1% trade. I placed a 0.5% trade and I tried to place another 0.5, and it's like, oh, no, you're maxed out. I'm like, what? So you have to account for leverage potentially. If you're at 1 to 100, you're probably fine. With the
This falls
proper
back
risk
into
management.
the goals though in the beginning, where like if your goal is that you want to pass a prop firm and be a prop firm trader, you need to set that goal in the beginning. And then you
Yeah.
need to also at the same time as you're building strategies and all this, you need to be thinking about what firms would you look into them, what ones meet your requirements. Like Jay messed up as a newer trader going for a prop firm. Like he should have looked into those requirements and realizing like, do I need this leverage? No offense to new trader Jay at the time, but you messed
Old
up.
Trader
Like that
Jay
was a
says offense taken.
yeah, no offense to that, but it's a pretty common mistake. So this is why we're telling you guys like make sure that it makes sense for what you're looking for, going and back to identifying the goal in the beginning as well. If you're looking to just grow personal accounts, a lot of this isn't really a problem, but we're going the prop firm route because that's more commonly asked about how would you go about risk management for those. A lot of these concepts, though, if you are doing a personal account, as a side note, are very good ideas to still keep in mind to help keep your account obviously active and not blow an
Yeah.
account. But as far as an actual leverage situation or something like this, or maybe margin, or maybe when you're looking at just the rules in general, having an idea of what firm you think you might go with and kind of looking into their rules while you're developing strategy will help you a lot more in the long run. Because if you get into a prop firm like Jane, then you're kind of screwed because now you have to kind of like on the fly readjust your whole entire plan a little bit to kind of fit. And that sucks to have to do. And that puts a lot more pressure on you. So definitely kind of consider the like kind of put that into the goal too. Are you looking to be a prop firm trader? If so, what firms would you maybe want to go with when you're building the strategy or personal? Just kind of identifying that in the beginning is also another recommendation I would give you guys.
Sidebar, like, because Christy loves her sidebars, old Jay was actually able to adapt and overcome, and after a few payouts, blew the account. So, fun fact. So,
Yeah.
moving on, days given a pass, literally the most fearful metric. Everybody's just like scared of this, and rightfully so. It's like a mental test in your head. You're against the clock, but a lot of firms are starting to give no time limits, which is really good. There's some more prominent and more like, I wouldn't say respected, but more like better standing prop firms, I will say.
Well
Like,
known or like
yeah,
popular ones who we would probably say are reputable. We know they've paid people out and stuff like that are starting
yeah,
to kind of adapt
reputable.
to
Why?
this.
I
Like,
don't know why I
no,
couldn't figure out that word. My
oh,
brain's turning to mush at this point, but
yeah,
it's important to test for these parameters and make sure your strategy is capable of passing in time. A lot of people don't even think about this in this regard. Refer refer to the profit target section that I just went over. Remember that 8 to 10%, depending, it could vary between challenges. In a month is 0.4 to 0.5% per day. That's all it is. Compounding small goals like this lead to huge accomplishments. So that's my motivational quote for the day. So get out there, be motivated, and kick ass, trader. You deserve it. All right.
very uncharacteristic of Jay to give a motivational quote. That's more like the
Evil
mindset
villain
people
laugh.
saying. Yeah, that's more mindset. But I mean, that was a nice,
Evil
like,
villain
nice little touch there, Jay.
summary. So the summary, Chris, and then we'll go into some examples of some
Yeah, let's get into the
some
examples because
hypotheticals.
they're falling asleep now at this point.
You need to take the time, Christy, I'm talking to you, however long it takes to define and develop a proper edge in the markets before going live. I don't care how hype you are after watching a few YouTube videos of this amazing 100% winning indicator. It's FUD. Like it's nothing. So you need to not, and listen to this too, you do not need to cover off every single section we went over here, but you
Yeah,
should consider how you want to go about your strategy with the recommendations given. And so there's three main sections that we went over that you absolutely need. You need risk management. Like
100%.
I don't care what you
100%.
say. Like just slap the unrisk management out of you. You need it. You need
Yeah.
a time horizon. You need to have a routine. You need a system where it's a repeatable system where you're at the charts at this time, you back test at that specific time. Don't change that. If you have to start trading a different time, back test that before you make that leap.
Consistency gives you the probable edge that you're looking for. If you can't prove consistency, you don't have an edge, which means you are just blindly going into the market. And you do not want to do that at all. So this is why you really should have some sort of routine or some sort of system that you're sticking to. It doesn't need to be the same exact time every single day. If well, Mondays you can only trade this session and Tuesdays this and Wednesdays this, like Jay kind of showed in different time frames in the beginning, that is okay. Just make sure that you're testing according to how you would be trading it. And don't just like say, hey, I just like my strategy and I got a signal during Tokyo session, but like you've never tested Tokyo and never trade Tokyo, and then wonder why you lost. And you're gonna be like, I don't understand what happened. And we're like, well, what's the testing? What's the data show? And you're like, I don't know. Like I tested all during London. And we're like, what? Why did you trade Tokyo that? So I mean,
I'm waiting for
take
Roxy to
some
bark in agreement, but clearly she doesn't agree with you right now. It's kind of
all I'm trying to say is make sure that you're taking some accountability there too if you do deviate from your plans, but please try to stick to them. There is the only way you can truly predict or not predict, but help to predict these markets or show a probability or anything like along those is by showing consistency in the past. And that's why we're saying a routine is important when it comes to this.
so you have proper risk management, you have a routine of specific time entering the charts. Now you need to know what you're actually doing consistently, and that comes with
Yes.
market conditions. You need to have a clear idea of what you're entering on a daily basis, certain trends that potentially form a lot of times, certain probabilities. Indicators may say sell, but you can clearly see you're forming a bullish structure and are out of support. So like probably don't want to sell. If anything, you want to wait until that support is potentially broken and retested on the top side as resistance, or the bottom side as resistance. Sorry. Other sections are interchangeable. You can strictly have a price action specific strategy. Many institutional traders and hedge fund traders use 70-30 fundamentals to price action technical analysis approach. You can incorporate both price action plus indicator based strategies like we do here at TTF. And then you can also scalp the news like everyday degens. No, I'm joking. But
No, there are some
more,
traders who do that, and no, not we're not throwing shade or knocking them. There are some people who truly do just follow news and scalp along
and
with
they
it.
have their own specific rules and it works for them, and
Yeah,
that's amazing.
yeah,
Moral of the story: whatever route you decide, you need to have clear defining entry and exit rules. Yes, certain things might be slightly subjective, but try to objectify as many things as you can. That frees up your thoughts. You don't have analysis paralysis, and it makes you accepting of the outcome of whatever happens. You can't expect to succeed if you haven't put in the time to fully test things out. Rarely in life or products, just an analogy, because Christy knows I love analogies. So rarely in life you see products delivered to the world on its first version or prototype. Like you won't see the failed attempts, the blow-ups, the light bulb moments, the frustrations, etc. You will only see the final product in its glory. And like, so you can't expect the first time you're trying a strategy, it's going to be perfect. You're about to be a millionaire. Like you are going to have trial and error. And if you don't have trial and error, you're able to find something, grab that and run with it. You got very lucky. That's
But
all I'm saying.
you will likely still need to make alterations and tweaks to it as the market conditions change, which they are always changing. So
Yeah.
like, you guys have heard us talk about it. Like we're in the middle of revamps for all of our indicators because the markets have changed over the past year and things need to be updated or changed to make sure that they're at their most optimal. And you guys, even with if you get lucky on the first try, that's fine. But don't forget all of these things and be like, great, I nailed it on the first try. Because you some point in time, your strategy may need revisions and you may have to actually put some of this stuff as far as like revising. And I like this message as far as like don't get frustrated because I do think that's it's fair to say like people think like oh it must be so nice you kind of get lost looking at testimonials or maybe what other people are at but you haven't seen all their failures. You haven't seen all the time that they've spent potentially making a system or testing or
You just see the final
really
product.
practicing. You're just seeing their final product. And, so when you sit there and say must be nice, you don't really know how nice it was when they were struggling in their own journeys. And everyone is at a
Thought
different
about
place in a different,
quitting and taking breaks
yeah.
and all that. But
So, but just be patient with yourselves and just know that it is a process doing this. And don't get frustrated that you maybe are hitting dead ends. We hit them all the time. Like we personally hit them all the time with our strategy building and like kind of get stuck and are like, oh crap, back to the drawing board. That's okay. It's part of the process of building the strategy. It is all worth it though if you do it correctly at the end. Like that's where it becomes all worth it. So just be patient with yourselves and don't put too much pressure on yourself to nail it the first time. It's okay if there's revisions that need to be
transitioning
made.
on making sure you do it correctly, I want to finish with the last statement of do not fudge your testing data because you want it to work. I know
Exactly.
how, like, you have been struggling to find a strategy that works for you, and you start subconsciously, like, oh, like maybe I ought to put my stop loss here. Oh, that's a win now. Like, test out your pairs and the strategy you're using, like you're interviewing a candidate to like join your company, like you're the CEO, and like you're interviewing people to like work for you. They need to convince you why you should trade them, not the other way around. It's not a failure if backtesting data is negative, it's actually a moral win. You save yourself losses that you would have experienced in the future. So I want
Exactly.
to leave you with that.
Yeah, I think that's huge too. Don't fudge your data. Don't just force it because you want it to look good or you want to feel better about yourself. Because at the end of the day, if you're not being honest about where you would place a stop loss, or you're kind of like being a little um like you're kind of looking ahead and maybe you are kind of like, oh, well, yeah, I would have known this or I would have known that potential. Like, no, you wouldn't have. So truly backtest, if you're backtesting, really, really backtest in replay mode where you cannot cheat yourself. And don't look ahead on purpose. Don't try and like make it easier and quicker and like see the market and then just throw your trades on because you will have a bias. You will subconsciously see what's coming and you will draw your stuff differently. Truly put your stop losses where you would put them, put it in replay mode and let them really play out. Because otherwise, I find that people tend to cheat a little bit. And then in live, you struggle and you wonder why. So that's our big tip there because when you're cheating it at the end of the day, you're just going back
You're
to the
cheating
drawing
yourself,
board. Yeah,
pal.
you are cheating. You're going back to the drawing board. You just wasted time. So just do it correctly the first time. And,
All right.
that way you don't have to worry about that too much. But
Building a strategy and trading plan, safe and neat.
finished.
Now,
So let's look at some examples. So what we're going to show you is a few examples of like this is hypothetical scenarios. This is not a true strategy
yep,
that we
literally
like
made
have
this up
tested.
yesterday.
We just are showing you guys how you would actually do this in practical application. So taking everything we just showed you in a PowerPoint slide and now
These are
applying
fake.
it to like what these would mean. So hypothetically, you make a set of rules for yourself. What would that look like on a chart? And then how would you make sure you're marking it up properly to then put into your back testing data? If you are in the TTF community, you have the journal, there's a how-to video on how to use it and all that. Highly, highly recommend you use a journal to put all of your stuff into. If you're not, you can Google free journals. They're literally out there. They're not as nice, but they are out there and they will do the trick. So there is free content out there for you guys if you need it. Or if you're an Excel whiz or like a Google Sheet whiz, like just create your own little sheet that you can type this into and keep track of like wins and losses, months, and stuff like that. So that way you guys can have a little bit of data while you're going through your testing. All right,
Okay,
so
so
let's show you.
for the higher time frame swing traders, we don't neglect you. I'm sorry, but majority of the higher time frames are institutional traders and like big money people. And so what they do is they focus on fundamental analysis. So I'm gonna give you a quick example. This is like a very straightforward example. As you can see, USD JPY skyrocketed in 2022. Why? Well, as I said before, the G7 countries that I listed before, they all met each other at the beginning of 2022 and they said, hey, inflation's getting really bad now. We all need to start raising interest rates, except Japan. Japan said, no, we're keeping it there. And as you can see here, I brought up the federal funds rate on Forex Factor. You can use that, MyFX Book, Trading Economics, and like other sites to get your news from. But the federal funds rate, which is the interest rate, as you could see from January 26th of 2022, we were less than 0.25%. And then throughout 2022, it just kept skyrocketing up, which increased demand for the US dollar, essentially. And then switching over to the BOJ policy rate, which is the Bank of Japan, as you could see from 2022, it was negative 0.1. You're basically getting paid to borrow money in Japan at this point. And it stayed the same. So it was getting weak compared to these people. And so as you could see here, January, from what we've seen in the data, January 6th, it was still 0.25. March 16th was whenever the height started happening. So March 16th on the daily time frame is at this point. So you could have literally, off of just fundamental analysis, place a trade off of here, recent structure, and then ride this bad boy up to glory. I drew this little rising wedge. It was a nice little price action / fundamental approach to it. But as you could see, you formed your high at the beginning of January and price went completely down. I just connected the lows. As you can see, the wedge finally broke. You could have anticipated that the US was going to raise interest rates and it broke out of this section. You could have placed your trade here or waited until the actual confirmation. As you could see, price broke here, you draw some levels and you just keep buying off of the supports because you know that USD just keeps raising interest rates and Japan's not doing anything. So that's a quick like fundamental approach of how you could trade that if you're swing trading. Also, going into the lower time frame, just completely flipping the script on this. What you could do, and what I've been doing recently, and like you could do as well, is I literally mark out a session. So in this case, I'm using Simple Session by TTF. Type Simple Sessions. You could see here the trade floor, 550 favorites, free indicator that you
It's
could
free
use.
for everybody. Yeah.
Yep. You can have all the sessions here and you can customize your user defined session, which I did in this case, 8:30 to 1500, which is indices open to an hour before New York close. I don't like trading the last hour New York close, so I don't accept it. So
That's for Jay's specific time frame, to be clear for you guys. You would put in
yeah,
your own
UTC minus
UTC
5.
time.
Yeah.
You would adjust it for your own UTC.
Well, you don't have to whenever you open the indicator, but if it's user custom indicator, you have to. But that's besides the point. Anyway.
Yeah, that's that's a different way.
You mark. So what I'll do is, let's say we're coming in. Obviously, we're coming into Friday, April 14th. You mark the high and lows from the wicks of the previous full New York session, as you can see here. What you want to do is you want to wait until price comes in that area, and then for, let's hypothetically, like I've done in the charts, what we want to do for execution wise is look for simple market structure and a pattern. What I chose is the simple W pattern. W patterns form with double bottoms, and then M's form with double tops. And for more information, Christy did a YouTube video on this, which was really awesome. So you can check that out more. But as you can see,
Yeah,
here,
I'll link it. I'll link it above for you guys.
Price legitimately gets to, I mean, it's nearly there at the zone. So I consider this good to go. And so as you can see here, price gets here, it forms a neckline, it comes back down, and it's going up now to form the W, so you can enter the trade. Christy has like her own methods. Like you can trade these W and M patterns differently, more aggressive or conservative. The conservative way is waiting until the neckline breaks. That way you have structure. But personally, making it more objective, another way to make it more objective and maybe a little more aggressive, what you could do is if a bottom forms and then a potential neckline forms, you don't know if it's going to be a double bottom. It could continue going down, but you draw a little fib right here. And maybe an objective rule you could have, like hypothetically, is if price double bottoms to form that W, you wait until price breaks and closes above the 50, and then you're good to enter. You're going to see some congestion at the neckline probably. You can target a recent high, which you get congestion from here. But looking left, you could see there's a huge fair value gap. And I drew a fib here That way you can easily see the 50 line. So the most aggressive approach would probably be just to target this area, which it ends up hitting. So another example, W and M patterns aren't going to be perfect. It won't always form perfect double bottoms or double tops, like in this case, but you can still use market structure in the sense of that. And so as you can see here, we're forming lower lows and lower highs. I kind of drew it in like the little yellow. And this is our lower high from this lower low. You could see this is the bottom of our potential W. We have our neckline up here. And this neckline breaks that lower high formation. So we're now looking bullish on the 5-minute. It comes back and it retraces and almost forms the double bottom, but it doesn't. We wait until this is a hypothetical rule that we just literally added. We wait until price breaks and closes above this 50 line, and we're in there like swimwear. So there's more examples. This W and M patterns don't happen every single day. They don't need to. These are quality trades, guys. Whether you took here or whether you did like the recent structure, you're making good rewards from here. And there's multiple examples, like we've seen here is a little mini M that forms. And so like I draw the low to the neckline, and this would be a potential entry. The problem with this that I have is that this is the lower high. And so you don't break that until later. And so like this might not be a valid entry for you if you're also incorporating market structure into this as well. Here is similar to that second example. You have your lower high formed here. Price makes your low for a potential W, your neckline. It doesn't come down here to form that double bottom, but you broke market structure and you had a nice retracement, and price breaks and closes above the 50. You're good to go there. And then you have another one. Last one I want to go over, though, is being careful around these areas. And so what I mean by this, like clearly you haven't really been at this area down here in a while. And so what could happen here is fake outs. And so you have your initial move down here. So we draw our little fib just to see whenever we want to enter. And as you can see, this candle would be where you could potentially enter. But hindsight's 2020. This doesn't work. But if you're using market structure, this is your lower high and it was never broken. And so that can kind of save you, depending if you want to filter things more, or if you not care, you want to try and take every M and W. If your testing works, then so be it. So that was just a quick example. What can happen a lot of times is if price hasn't gone a place in a while and you have a huge candle like this, what people will do is they'll place pending orders for breakout traders who just want to sell. And so the market would be like, haha, I got you. So sell side, grab that liquidity and just literally make stonks, because this is coincidental, but this fake out just made this entire move. So one thing to consider.
But I want to quickly just comment on this and clarify again. This is not an actual strategy.
This isn't strategies.
He's
this is
only
just
showing this to you, and he really
examples
went longer than he needed to there, Jay. But because he's kind of making it sound like it's an actual strategy. He's showing it to you because when you are going to be creating your strategy, he's just trying to give you an idea of like, it could be something so simple like this, that there's set rules though. You're having the same reason for entering, even if it's subjective.
Doubt, then make a rule for it. Like try and make an objective rule if there's doubt. If you don't know, like should I do this or this, test for it, define a rule for it. So
even if it's subjective, kind of like these can be subjective, visualizing a W or an M. And when you draw it, somebody's like, oh, I see it now. But trying to visualize it yourself or telling somebody else to find the same W and M as you may get lost on some people. So it can be a bit subjective. But like he said, if it's a subjective thing, try to find an objective way to test it if possible. If you're kind of stuck with this and you need some help, definitely hit us up in the Discord and ask us in the strategy support room, because we might be able to help you a little bit with like a recommendation there. But I just want to clarify that the other thing I do want to point out is he's making this look very simple if you do decide to do something with W's and M's, because to be fair, W and M's are a real thing. Like I said, there is a video I show about it. But to clarify, you do not take every W and M that fall within your zones. The ideal is to be taking them near one of those zones. So hypothetically, you're near a resistance level and you see a little W form. You would not take that little W that close to a resistance, because your place to go, your ability to travel to a stop or to take profit is likely not all that large. And there was a couple of them I saw in there and he didn't mark them up. So I want to make that clear though. If your risk to reward does not make sense and it is not good, when you're about to go into another zone that it hasn't shown to have broken yet, don't take that W or M. You're only taking them when they are clearly rejecting off of a support or resistance, or they're breaking through a level. Do not take them when they're kind of stuck in that middle like consolidation zone or level, because that's just like asking for trouble. You're probably going to get stuck at one of those. There's no clear indication that it has actually broken that level yet. That's kind of a zone to zone thing. And again, this is not a strategy, but I just want to clarify that if you decide to be like, oh, this looks great, I love W's and M's now all of a sudden, and you didn't listen to anything else we just said, and you're all of a sudden you're out there now testing W's and M's, just make sure that you're being smart about the risk to reward, because risk management, like we said, is huge when we're talking about this. And if the risk management isn't good, you're not going to do good. You need to make sure it makes sense.
Those are just quick examples. Like we've been saying, hypothetically, you're probably tired of us hearing that word, but like that, those strategies aren't set in stone. I just put that as like literally examples that you can go off of. We're tight on time, so we're gonna have to end this here. The last example I had was just marking up daily zones where resistance turns to support or impulse moves. Where was the price last at its lowest point before it skyrocketed, or vice versa? Like mark those specific levels, draw trend lines, and then go on like a 30-minute or 1 hour and trade off of those rejections. It could be as simple as that. But that wraps up everything here. Wraps up season 2, episode 10. I really hope that y'all learned or got some nuggets out of this, because this was very, very popular request that we had. So hopefully we were able to answer some of the questions that y'all had. We appreciate everybody. Make sure you like and subscribe, and then make sure you like us on all the podcasting apps, and make sure you stay in tune. We will have one more episode, like we said, that's happening May 2nd, I believe. Yeah. And it'll be coming out May 2nd.
Or... No, I don't know. I agreed with you. It's happening on Thursday, the 27th.
With a
May
live.
2nd happens to be our
There's a live on Artie's channel, The Moving Average. There's a live that will be happening. I probably won't be able to be there. Electricity's a B. But that's going to be happening. But then the podcast is going to be out on May 2nd, though, right? So,
so you're going to be hearing about this probably.
Stay tuned for that.
Happened.
It already happened. Stay tuned for that, guys. Stay safe and happy trading. Peace.
All right, bye.